Let's get straight into this, because what I'm about to explain isn't speculation, fear marketing, or some doomsday scenario designed to grab attention. This is about policies that already exist, policies quietly approved and implemented across major financial systems around the world. And most people have absolutely no idea. I need you focused for the next few minutes because this directly affects anyone who keeps money in a bank account, savings, checking, business accounts, all of it. There's a regulatory framework now active across more than 24 major economies, including the United States, the United Kingdom, Europe, Australia, and others. The framework is known as bail-in resolution. And if that term sounds unfamiliar, here's the plain English version. In a future banking crisis, the government may no longer rescue banks using taxpayer money. Instead, the bank rescues itself using its own creditors, including depositors. That includes you. Under bail-in rules, when a major bank faces collapse, deposits above insured limits can legally be converted into bank equity to stabilize the institution. In other words, money you thought was safely stored in your account can be used to recapitalize the bank. Your savings can be turned into shares in a failing bank. Overnight, you could go from depositor to unwilling investor. And this isn't some future proposal. It's already part of financial regulation. Organizations like the Financial Stability Board, global banking regulators, and deposit insurance authorities across major countries have signed onto this structure. After the 2008 financial crisis exposed how fragile the system really was, policymakers decided taxpayer bailouts were politically unacceptable. So they created another solution. Instead of governments saving banks, depositors helped save them. The blueprint for this was tested in real life. Countries dealing with banking collapses in the past decade implemented versions of this framework, proving regulators are willing to use depositors' funds to stabilize financial institutions. And here's why this matters now more than ever. We're entering a financial environment where global debt levels are at historic extremes. Governments, corporations, and households worldwide are carrying debt burdens never seen before. At the same time, central banks are stuck. If they raise interest rates too much, economies slow and debt becomes unpayable. If they lower rates and print money, inflation accelerates and currencies lose value. Traditional rescue tools are running out of effectiveness. That means in the next serious crisis, authorities will likely rely on mechanisms already prepared, including bail-ins. And most people aren't even aware this is possible. So in this series, I'm going to walk you through how bail-ins actually work in practice, why regulators now prefer them over bailouts, why the risk environment is rising again, and most importantly, what steps individuals can take to protect themselves and position wisely, because this isn't about panic. It's about preparation. By the end, you'll understand how the system functions and how to protect your wealth intelligently instead of reacting too late. Now, before we go deeper, we need to introduce a concept that frames everything we're about to discuss. It's called asymmetric wealth protection. Most people invest assuming the financial system remains stable. They diversify into stocks, bonds, maybe real estate, expecting markets to fluctuate, but rules to stay constant. But we are no longer in that kind of environment. The rules themselves are changing. Financial systems today operate under extraordinary stress, debt expansion, monetary experimentation, inflation pressures, and geopolitical shifts. Under these conditions, the biggest risk isn't market volatility. It's systemic change. Asymmetric wealth protection means recognizing that certain traditional assets now carry much larger downside risk than most people realize, while some protective assets offer disproportionate protection if conditions worsen. For example, leaving large amounts of money in unsecured bank deposits may feel safe, but if crisis hits, that money could become part of a bank rescue mechanism. On the other hand, assets held outside the banking system carry very different risk profiles. The asymmetry comes from this. Your potential loss from moving part of your wealth into protective assets is limited, but your protection during systemic stress could be enormous. And that difference matters when financial systems are under pressure. So here's the big idea we'll build on moving forward. The probability of banking stress is rising again globally. Resolution strategies have shifted from bailouts to bail-ins, and most people remain unprepared. But those who understand the shift early can protect their wealth and potentially benefit from the economic transitions ahead. because this isn't about predicting exact timing. It's about understanding how the game works and adjusting before everyone else realizes the rules have changed. And to fully understand why this matters, we need to look at history, because this has happened before, and financial crises follow patterns. So in the next part, we're going to step back and examine past banking collapses and currency crises, starting with the banking panic of the early 1930s and moving forward from there. History shows us exactly what governments do when financial systems begin to crack, and the patterns are impossible to ignore. To understand where things could be heading, we need to step back and examine moments in history when banking systems actually broke down, not just markets falling, but the financial plumbing itself failing. Because when that happens, governments don't simply sit back and let events unfold. They change the rules. And one of the clearest examples comes from the early 1930s during the Great Depression. Most people remember the stock market crash of 1929, but what truly devastated ordinary citizens came afterward: the collapse of the banking system itself. Between 1930 and 1933, thousands of banks across the United States failed. Entire institutions simply shut their doors because they didn't have enough cash to meet withdrawal demands. Here's why that happened. Banks operate under something called fractional reserve banking. That means banks don't actually keep all depositor money on hand. Instead, they lend most of it out through loans and investments. Normally, this works because not everyone withdraws money at the same time. But once people panic, everything changes. When depositors rush to pull money out simultaneously, banks don't have enough liquid funds to pay everyone. Loans and long-term investments can't be turned into cash quickly enough. So banks collapse. And when banks collapsed in the early 1930s, millions of Americans lost their savings. Entire lifetimes of work vanished almost overnight. The government responded with major reforms. First, deposit insurance was introduced to restore public confidence. Deposits up to a certain amount were guaranteed, reducing panic withdrawals. But here's the part history books rarely emphasize. In 1933, the U.S. government also made private ownership of gold illegal. Citizens were required to turn in their gold holdings to the government at a fixed price. Shortly after, the government revalued gold higher, effectively devaluing the dollar. What does that mean in simple terms? People were forced to sell their gold cheaply, and then the currency was adjusted, transferring wealth away from private citizens and toward government balance sheets. It was done under emergency powers. The lesson here is uncomfortable but important. During systemic crises, governments prioritize stabilizing the financial system and the state, even if that means rewriting economic rules or forcing asset adjustments. Now let's fast forward a few decades to another critical period, the inflation crisis of the 1970s. This period matters because the economic conditions back then look surprisingly similar to pressures building today. In the early 1970s, the global monetary system shifted dramatically when the U.S. ended the dollar's convertibility into gold. The result was a decade marked by inflation, economic stagnation, and uncertainty. Prices surged. Economic growth slowed. Unemployment climbed. Confidence in currency weakened. And during this time, something interesting happened. Traditional financial assets performed poorly in real terms. Cash lost purchasing power. Bonds delivered returns that failed to keep up with inflation. Even stocks struggled for much of the decade once inflation was accounted for. But assets tied to physical scarcity behaved differently. Precious metals surged as investors looked for protection against currency debasement and inflation. People weren't buying metals to speculate. They were seeking safety outside financial systems, losing credibility. Investors who positioned early didn't just preserve wealth, many multiplied it. And the reason was simple. When currencies weaken and inflation erodes savings, people move toward assets that cannot be easily created or manipulated by monetary policy. That pattern repeats throughout history. But now let's jump closer to modern times, because the real turning point for today's banking framework happened in the past decade. And that turning point was Cyprus in 2013. Cyprus faced a severe banking collapse due to heavy exposure to failing debt and bad loans. The banking sector became insolvent, and the government needed international assistance. But international lenders imposed conditions. Instead of a traditional bailout funded by taxpayers, authorities required banks to recapitalize themselves internally. And that meant depositors took losses. Deposits above insured limits in major banks were partially seized and converted into bank equity. In some cases, depositors lost a massive portion of their savings. People woke up to find that money in their accounts had been replaced with shares in broken institutions. And here's the key point. This wasn't rogue action. It was coordinated policy endorsed by international financial authorities. And from a regulator's perspective, it worked. Banks stabilized without massive taxpayer-funded bailouts. But Cyprus became something else too, a template. After this event, global regulators formalized bail-in resolution frameworks, embedding them into law across major economies, meaning the mechanism now exists legally in multiple countries. And here's why this matters today. Because the global economic environment once again shows stress signals. Debt levels are historically high. Growth is slowing in many regions. Financial markets are increasingly fragile, and confidence can shift quickly in modern interconnected economies. When pressures rise again, authorities already have a playbook prepared. And in Part 3, we're going to connect all of this history directly to today's economic conditions, global debt, financial repression, and how a modern bail-in could actually unfold step by step. Because once you see how the mechanics work, the risk becomes much clearer. Now let's bring everything into the present, because history only matters if we understand how those same pressures are showing up again today. And right now, multiple economic forces are converging in ways that make financial systems increasingly fragile. Let's start with the biggest issue, debt. Global debt, government, corporate, and household combined, has reached levels never seen before. Countries around the world are carrying enormous obligations, while economic growth is slowing. The problem with excessive debt is simple. Debt only works when income grows fast enough to repay it. When growth slows but debt keeps rising, eventually something breaks. Governments know this. Central banks know this. Markets know this. But politically, cutting spending or defaulting on obligations is nearly impossible. So policymakers rely on a quieter solution known as financial repression. Here's what that means in practical terms. Financial repression occurs when governments keep interest rates lower than inflation for extended periods. If inflation runs at 4% and savings accounts pay 1%, your money loses purchasing power every year even though the number in your account stays the same. It's like a silent tax. Over time, this reduces the real value of government debt while transferring wealth away from savers. And this has already been happening for years. But here's where the risk increases. Not only are savings losing purchasing power, but deposits above insurance limits could also become tools for stabilizing banks in a crisis. So let's walk through how a modern bail-in might actually play out. Imagine a large regional bank runs into trouble. Maybe commercial real estate loans begin defaulting. Maybe financial markets panic and depositors rush to withdraw funds. Confidence disappears quickly in banking. The bank suddenly doesn't have enough liquidity to meet withdrawal requests. At that point, regulators step in. Authorities place the bank into a resolution process over a weekend to prevent panic spreading. Shareholders are wiped out first. Bondholders take losses next. But if the losses are larger than expected, regulators then move to uninsured deposits, meaning money above deposit insurance limits. Those deposits can legally be converted into equity to recapitalize the institution. So imagine someone with $500,000 in one bank. Deposit insurance protects only part of it. The remainder could be converted into shares in a restructured bank. And here's the critical detail. Depositors don't get to vote or opt out. By Monday morning, accounts reopen and part of their savings has turned into stock in a troubled institution. Another mechanism makes this even more significant. Banks today are required to maintain something called loss-absorbing capacity, meaning they must have financial buffers ready in case of crisis. And uninsured deposits are counted as part of that buffer, which means large deposits are already considered potential loss absorbers within banking regulations. This isn't hidden information. It exists in regulatory frameworks and disclosures, but very few everyday savers understand it. So the question becomes, if financial risk is rising, what can individuals actually do? There are three broad strategies people discuss when trying to reduce systemic exposure. First, many investors look toward assets outside the banking system. Physical assets that don't rely on financial institutions remove certain counterparty risks. Some investors view precious metals or other tangible assets as ways to hold value outside traditional banking structures. Second, others look toward decentralized or alternative stores of value. Digital assets and real-world productive assets are sometimes seen as ways to diversify away from purely financial claims denominated in currencies subject to inflation and policy shifts. And third, some investors focus on diversification across institutions and jurisdictions. Instead of keeping all funds in one bank or one country, they spread exposure to reduce concentration risk. The goal isn't necessarily to predict collapse. It's to build resilience. Because crises don't announce themselves in advance. They happen suddenly, and options become limited once panic begins. So smart preparation focuses on flexibility before problems emerge. Now, before we move into the final part, we need to shift from theory into action. Because understanding systemic risk means nothing if you don't know what practical steps to consider. In the final section, we'll break down practical actions individuals often consider when managing financial risk in uncertain environments. And we'll wrap everything into a clear framework for thinking about wealth protection in the years ahead. Because whether crisis happens next year or 5 years from now, preparation is always easier before pressure builds. Now let's close this out by moving from awareness to practical thinking, because information alone doesn't protect anyone. Action does. Understanding systemic risk is only useful if it leads to smarter decisions about how you manage and protect your money going forward. And here's the key mindset shift. This isn't about predicting a financial collapse tomorrow. No one knows the exact timing of crises. What matters is recognizing that risk environments change and preparing before stress appears. Because once panic starts, options shrink fast. So let's talk through practical steps people often consider when building financial resilience. The first step is simple awareness. Look at where your money actually sits. Many people spread investments across stocks, retirement accounts, and funds, but keep large cash balances concentrated in one bank simply out of convenience. Understanding deposit insurance limits and how much of your cash is actually protected is an important starting point. Some people choose to distribute funds across institutions to reduce concentration risk, while others prefer moving portions of cash into assets outside the banking system. The right approach depends on individual circumstances, but awareness is the first defense. The second step involves diversification beyond purely financial assets. Traditional portfolios rely heavily on stocks and bonds, assets tied to financial markets and economic growth. But in environments where inflation, debt, or systemic pressure rise, many investors consider adding exposure to assets that behave differently than financial markets. This can include tangible assets, productive investments, or other stores of value that don't rely entirely on banking structures. The idea isn't abandoning markets, it's reducing dependence on a single system. The third consideration is liquidity and flexibility. In financial crises, access to funds becomes more important than theoretical portfolio value. Markets can freeze, banks can limit withdrawals, and transactions can slow down. Maintaining accessible resources, emergency funds, and diversified access points becomes critical during stressful periods. Flexibility provides options when conditions change. Another increasingly discussed strategy involves geographic or jurisdictional diversification for those with significant assets or international ties. Some individuals choose to hold assets or accounts in more than one country to reduce exposure to any single regulatory environment. This isn't about hiding money or avoiding obligations. It's about managing risk in an interconnected global economy. The final step, and perhaps the most important, is continuous education. Financial systems evolve constantly. Policies shift. Regulations change quietly while most people are focused elsewhere. Staying informed, questioning assumptions, and understanding how macroeconomic changes affect personal finances helps people make proactive decisions rather than reactive ones. And remember something critical. Most financial crises don't look obvious beforehand. They feel manageable until suddenly they aren't. In 2007, very few people expected the global financial system to freeze the following year. In early 2020, few predicted how rapidly global economies would shut down. Financial stress tends to appear gradually, then suddenly, which brings us to the central message of this entire discussion. The coming years will likely test financial systems in ways we haven't seen in decades. High debt, policy challenges, geopolitical shifts, and economic transitions are creating uncertainty. Some people will ignore these signals and hope systems function as they always have. Others will quietly prepare and position themselves intelligently. And preparation doesn't require fear. It requires awareness, diversification, and flexibility. Because wealth preservation isn't about predicting disasters. It's about ensuring stability regardless of what happens. So here's the final question to leave with you. If financial stress appeared tomorrow, would your current setup protect you or expose you? Take some time to think honestly about that. If this discussion helped you see risks and opportunities more clearly, consider sharing it with others who might benefit from understanding how the financial system is evolving. Because mainstream conversations often focus on markets going up or down, not on how the system itself changes under pressure. And understanding those structural shifts gives you an advantage most people never realize they need. The next few years will be defining for wealth preservation and financial positioning. The decisions made quietly today often matter far more than reactions made in panic tomorrow. Stay informed, stay adaptable, and most importantly, stay proactive. Thanks for watching, and I'll see you in the next one.